Imagine this. A company just dropped earnings that shattered expectations. Revenues are soaring. Profits off the charts. Growth so aggressive it makes other tech firms look like they're standing still. You'd expect its stock price would be soaring like its revenue and earnings, right? But that's not the case. NVIDIA, the crown jewel of AI, is down 17% this year. Currently, analysts have it with a price target near $170, yet investors are treating it like yesterday's news. So what is going on? Is this an obvious buy the dip moment, or are we ignoring some red flags? Stick around because today we're breaking down the truth behind NVIDIA's surprising slump and whether this tech titan is about to boom again or continue its slide downward. So why is one of the most dominant forces in technology, one that's powering AI, gaming, cloud computing, and even robotics being punished? Well, it's part psychology, part valuation anxiety, and part Wall Street doing what Wall Street does best, overreacting. Some investors are simply taking profits after NVIDIA's monster run in 2023 and 2024. Others are hesitant because AI, while booming, still faces some regulatory and scalability uncertainties. And more recently, there's a new wrinkle, the tariffs introduced by President Trump, which have cast a shadow over U.S. tech giants with heavy international exposure. For a globally integrated company like NVIDIA, these policy changes introduce near-term friction, adding another reason for cautious sentiment despite the strong fundamentals. But that's only half the story, because when you peel back the layers and look at the data, NVIDIA isn't just surviving this environment, it's thriving in ways most companies can't dream of. Let's start with one of the most debated metrics, the EV/EBITDA ratio, or enterprise value to earnings before interest, taxes, depreciation, and amortization. Yeah, it's a mouthful, but it helps investors assess a company's overall value, including debt, relative to cash earnings. NVIDIA's ratio is sitting at 32. To a traditional investor, that might seem high, but let's compare a few others to that. If we look at Palantir, an AI software company, Darling, it has an astoundingly high ratio near 800. Or ServiceNow, a workflow automation company, they're around 90. When you compare NVIDIA to them suddenly, NVIDIA at 32 looks pretty reasonable, right? And then there's Microsoft, the gold standard for consistent growth, sitting at a modest 21. But here's the difference. Microsoft's growing in the single digits. NVIDIA is delivering triple-digit growth in some segments. So is it fair to value it like a slow and steady dividend-paying company? Probably not. And if you need more proof that NVIDIA plays in a different league entirely, just look at the one metric that cuts through all the hype, free cash flow. NVIDIA's free cash flow yield is currently sitting at 2.23%. Now, that might not sound flashy, but let me put it in context. Free cash flow is what a company has left after paying all its bills and reinvesting in its future. It's like personal savings. After you've paid your rent, groceries, student loans, and spent a little too much on DoorDash, how much do you actually have left to invest? For NVIDIA, even after spending billions on research and expansion, they're still printing billions more in actual cash. Now, look at the other companies we mentioned earlier. Palantir is at 0.42%, ServiceNow 1.86%, and Microsoft a very respectable 2.19%. NVIDIA is clearly doing well balancing risk and reward while still dominating every growth category it enters. And by the way, if you're enjoying this breakdown so far and want more investing insights like this, tap that like button and hit subscribe. It's free and it helps out the channel a bunch. But even with a strong cash flow and competitive positioning, some investors still get nervous when they see one particular number, the price to sales ratio. At 21, NVIDIA isn't cheap by this metric alone, but here's why context is king. How about Palantir? Over 90. ServiceNow around 17, and Microsoft, more diversified and mature, is around 12. So yes, NVIDIA's price to sales ratio is elevated, but it's in line with or below other high growth tech leaders. And more importantly, NVIDIA doesn't just participate in its markets, it dominates it. They're not selling components like a supplier. They're building entire platforms. Their chips power everything from cloud infrastructure to robotics to generative AI. They're providing the brains behind the smartest systems on Earth and increasingly space. And if you're looking for a way to play NVIDIA's upside without going all in on a single stock, check out my breakdown on SMHX, an ETF with over 20% of its holdings in NVIDIA. It's a smart way to get diversified exposure while still riding the AI wave. I'll link that video at the end and in the description. So that's what sets NVIDIA apart. It doesn't just sell into markets, it creates them. So what's the short-term outlook? Honestly, it looks like a launch pad. Demand for GPUs is off the charts. Data centers are scrambling to lock in capacity before AI growth pushes demand even higher. And enterprise adoption of AI tools, it's exploding. Every CEO wants to say they're leveraging AI, and guess whose logo is behind the scenes when they do? You guessed it, NVIDIA. And Wall Street has definitely noticed. This isn't just hype from tech blogs or earning calls buzz. Analysts aren't just cautiously optimistic, they're overwhelmingly bullish. 41 out of 44 analysts rate the stock as a buy or strong buy. The average price target is around $168, which would be a gain of over 50% from today. And some of the more aggressive firms are calling for a price target of 200 or more, essentially a full reversal of this year's losses and then some. That's not Reddit crowd enthusiasm. That's institutional grade confidence. And when you zoom out to the big picture, NVIDIA's role becomes even more compelling. This isn't just a company riding the AI wave. They're the ones building the wave pool. They power the infrastructure behind AI training models, the supercomputers crunching massive data sets in the cloud, and the cutting edge hardware that gamers and developers rely on. Their chips are the muscle behind robotics, self-driving systems, and even AI-powered medical breakthroughs. If AI is the gold rush of our era, NVIDIA isn't just selling the shovels, they're building the roads, setting up the towns, and charging tolls at every turn. And they're not doing it piecemeal. From CUDA, NVIDIA's proprietary AI software platform, to the Omniverse, which connects virtual worlds with real-time simulations, NVIDIA is laying the groundwork for a future where AI and immersive computing redefine how we live and work. Their tech isn't optional, it's foundational. And when your company is essential to how industries evolve, that's not just innovation, it's insurance. So pulling it all together, what does the full picture of NVIDIA tell us? Their EV/EBITDA ratio sits at 32, not dirt cheap, but absolutely reasonable when you're talking about a company with hyper growth credentials. The free cash flow yield of 2.23% shows this isn't just a paper tiger. It's generating real, reinvestable money while scaling aggressively. The price to sales ratio at 21 might raise some eyebrows, but it's well earned when you consider NVIDIA's dominance across multiple markets. And analyst sentiment, overwhelmingly bullish, with nearly all major firms shouting buy. And the potential upside? In the short term, we're talking about 40 to 100% gains if sentiment and earnings align. Long term, this could be the defining growth stock of the decade, the kind of name investors look back on and say, why didn't I buy more? And yet, the stock is down 17% this year. Now, I don't want to ignore the fact that the recent tariffs implemented by President Trump have definitely clouded the future of NVIDIA and many other U.S. companies, but that will likely be a short-term impact. And NVIDIA has all the makings to make another run to $200 per share or even higher. And always, with any investment, there's always risk because no one can predict the future of a company or the market. So, what's your move? Are you taking advantage of this significant dip and loading up before NVIDIA Q2 earnings at the end of May? Or are you waiting to see how the tariffs play out? Let me know in the comments. Is NVIDIA a buy right now, or are you watching from the sidelines? If this breakdown helped clarify things, smash that like button and hit subscribe if you want more no-nonsense deep dives on the market's biggest opportunities. As always, thanks for watching and hanging around till the end. Remember, I'm here to make content focused on your money and how to manage it best. See you in the next one.